quality, red flags and accounting warning signs. So we're looking for signs of earnings management in this reading. Okay, our first LOS asks us to describe incentives to over-report or under-report earnings. Now, of course, one very common one is to meet analysts' expectations. So analysts have expectations of our earnings. We realise we're not going to meet those expectations, and as a result, it leads to earnings management as we attempt to try and hit those expectations. Meet debt covenants. We know a lot of our bonds may have covenants built into them, and those covenants may be ratio-based, such as interest coverage or solvency ratios. So if we're going to breach a covenant, which leads to a technical default, which at worst could lead to our debt being recalled, or even at the minimum, it's going to cause the cost of finance to rise. So if we realise we're going to breach a technical covenant, we may manipulate the financial statements to avoid the breach. And then the final one here, improve incentive compensation. So bonuses, stock options, anything that's linked to the accounts, of course, we're going to try and manipulate our accounts to make sure we get paid that bonus. Motivations to underreport earnings, to obtain trade relief, so in other words government subsidies if we're loss making, to negotiate lower payments for contingent consideration. Well, imagine a scenario where you've bought a subsidiary and the price you pay is based on an earn-out. In other words, the price you pay is based on the future earnings of the subsidiary. Lower future earnings of the subsidiary, lower price you pay. So you may have an incentive here to underreport that subsidiary's earnings. Or to negotiate concessions from trade unions. So for example, you want to make people redundant from your firm. It's very difficult to make people redundant if you're very profitable. So let's report losses. That may give us a bigger bargaining position to negotiate redundancies with our trade unions. Motivations and manipulation of the balance sheet. Well, of course, we're going to have motivations here to either overstate assets or understate liabilities. Why overstate our assets? Well, of course, and understate our liabilities to improve our leverage ratios. Maybe it's we're comparing assets to equity, or maybe we're looking at debt over equity, so to improve our solvency position, or to improve our liquidity ratios, things like the current ratio, the cash ratio, and the acid test ratio. Motivation to understate your assets. Well, of course, if you understate your assets, you're going to improve your return on assets. What's our return on assets? If you remember return on assets from earlier, net income over our total assets. Again, strictly speaking, it should be average total assets, but you understand. Asset turnover, of course, would be sales over assets. Okay, so maybe we want to improve those ratios. Decrease solvency, of course, may be able to enable us to negotiate concessions from our creditors or our employees. And of course, if we report higher goodwill on acquisition, well, we know, remember, our goodwill on acquisition, what we do is we look at the proceeds, what we pay to acquire the subsidiary, compared to the fair market value of the net assets we acquire, and the difference, of course, is our goodwill. Well, we know if we make fair market value adjustments, maybe we increase the plant, property and equipment of the subsidiary we acquire, well, that will have a knock-on impact on future income statements via higher depreciation. So we have an incentive to minimise the fair market value adjustments in order to maximise goodwill. Why might we want to maximise goodwill? Because, of course, it's not amortised. So unless there's an impairment in the future, goodwill is going to have no impact on future income statements. Okay, we're asked to describe signs of low quality earnings here. So the first one here, selecting alternatives within generally agreed accounting practice that distort our results. So maybe we start to use LIFO when in fact we should be using FIFO. So for example, maybe we actually sell the oldest items first, and as a result our ending inventory is made up of the most recent purchases, but we choose LIFO in our accounts. Why would we choose LIFO? Maybe to minimise our tax. Or maybe our depreciation methods. Maybe we choose a straight line depreciation method when maybe we should be choosing accelerated. So maybe actually our asset generates higher revenues in the earlier years, and as the asset ages, of course, it generates lower earnings. Now, International Accounting Standards, of course, says you must use an accelerated method in that point, whereas US GAAP doesn't. So even though your asset's earnings potential is declining over its life, you might still choose a straight line depreciation method. Using loopholes or bright line criteria to report legal rather than economic substance. Well, of course, a classic example of this that we still have is operating lease versus our finance leases. We know the issue with operating leases, there's no balance sheet recognition of an asset, there's no balance sheet recognition of a liability. So if you make sure you structure any leased assets as operating leases, you avoid including the debt in your balance sheet. Bright line criteria in the past used to be as well the idea that you only had to consolidate if you had over 50% of the equity in a subsidiary. So what companies used to do is set up special purpose vehicles where they weren't the majority shareholder, and as a result they could equity account rather than do a full consolidation. And that was a good example of using bright line criteria to report legal rather than economic substance. And of course that's what Enron did. There's been changes in special purpose vehicle rules since then, of course, that now says if you have the risk and reward, regardless of share ownership, it's a subsidiary, you now must consolidate. Using unrealistic or inappropriate accounting estimates and assumptions. So remember what we said, if we increase the economic life of our plant, property and equipment, we'll reduce the depreciation charge each year. So higher economic lives, higher salvage values, we're going to get lower depreciation going through our accounts and as a result higher earnings. Stretching an accounting rule to achieve a desired result. So for the example of our special purpose vehicles, in the past, even if you had the risk and reward of a special purpose vehicle, if you weren't the majority shareholder, you could get away with something called equity accounting. And with equity accounting, you just brought in your share of the net assets of the other entity. Now for special purpose vehicles, they're very thinly capitalized, i.e. they have very high assets, very high liabilities, but very low equity. So net assets, therefore, is very small, and you are bringing in a very small proportion, therefore, or your share of a very small figure. And then, of course, finally, fraudulent financial accounting, which, of course, means we've got zero quality of earnings. So, for example, the scenario of WorldCom, where they took a load of their operating expenses and capitalized them, keeping them out of the income statement and storing them in the balance sheet. Well, our next LOS, and isn't that pretty, asks us to describe the fraud triangle. So here's our fraud triangle. The idea is there are incentives or pressures on the management. There's opportunities to commit the fraud. And then finally, the management have the ability to rationalize their behavior. Nobody wants to think of themselves as a fraudster, so therefore they want to be able to rationalize it. Oh yeah, I did it, but I did it for the shareholders. I did it to protect the company, etc. Okay, so what we're now going to do is just run through each of those three elements and to look at the kind of items that could cause them to occur. So let's start off with our incentives and pressures to commit a fraud. So the first thing is to look at the economic, industry or entity operating conditions. So in other words, if competition increases, market saturation increases and your profit margins start to decline, if your profit margins start to decline, your earnings are going to start to decline, so maybe there's more incentive to commit fraud to maintain your earnings. If there's been rapid technological change and as a result some of the products that you produce are now obsolete, again your earnings are going to start to fall, so as a result you may want to commit fraud to keep those earnings up. If the consumer's trends and tastes change, again the demand for our product might diminish and as a result our earnings drop, again giving us an incentive to commit fraud to maintain our earnings. Operating losses, okay, so we're making losses from our day-to-day trading activities. Well, and again, we know, of course, that could increase bankruptcy risk or foreclosure on our debt, of course, if we breach covenants, or even lead to a hostile takeover. So again, an incentive to maintain your earnings by committing fraud. Recurring negative cash flows. So maybe even if earnings are positive, our cash flow from operations are negative. And again, of course, this won't be sustainable in the long run. Rapid growth or unusual profitability, again, could be an indication that a fraud has been taking place, or there's new accounting and regulatory requirements that change our earnings position. Let's have a look at pressure on management from third parties. Well, again, we've talked about a few of these before. In particular, the first one, where there's pressure on management to meet the expectations of analysts. So it might be to meet the expectations of analysts, or significant institutional investors that have large shareholdings, or even significant creditors where you owe money. Of course, if you need to obtain additional finance, so you're going to need to issue new debt, new equity, then you're going to want to present your balance sheet and income statement in the most favourable light. Why? To obtain the best possible credit rating for your debt, to obtain the best possible share price for your equity when you issue it. Exchange listing requirements, again. So again, there may be minimum requirements that we need to meet in order to get a listing on an exchange. Again, incentive therefore to manipulate your financial statements to ensure you meet those requirements so that you can get your IPO. Debt covenants we've mentioned in the past. So again, there's activity-based ratios in there, such as solvency ratios, liquidity ratios, interest coverage ratios. Again, if it looks like we're going to breach those, we'll be in technical default, allowing our debt holders to renegotiate the terms of the debt, or at worst, of course, call that debt back. So in order to avoid breaching those debt covenants, we may manipulate our balance sheet and income statement. And then you can see as well impact on pending transactions, business transactions, contract awards. So maybe we're looking at taking over a company and the price we pay is linked to our share price because we're using a share-for-share transaction to acquire the other company. Directors' personal financial position is threatened. So maybe we're looking at smaller companies here where the directors have cross-guaranteed the debt in these companies. So we could be looking at a situation where the directors have a significant financial interest in the entity, maybe because they've got a lot of equity, or maybe they've cross-guaranteed the debt in the other company, and as a result they don't want share price to decline, or they don't want the debt to be recalled as a result of breach of covenant. Significant contingent compensation, of course, is looking at the directors having bonuses and stock options. Well, again, if your bonus is linked to financial performance or stock options are linked to financial performance, you're going to want to make sure you meet those criteria in order to receive the bonus. And then finally, personal guarantee of the entity's debt. If the directors are responsible for the debt in the entity, if that debt is recalled or the entity goes insolvent, of course, the directors are responsible for the liabilities. As a result, they're going to want to make sure that company does not go insolvent, does not go into liquidation by potentially manipulating the financial statements. Okay, so we've looked at some of our incentives. Let's move on and look at some of the opportunities. First one there is significant related party transactions. We know what these are. These are transactions between the companies and insiders. Now, of course, the idea here is they may not be at proper commercial terms. So there's the idea that we could commit fraud here. So, for example, I might sell myself a car from the company, maybe a motor vehicle, and rather than selling it to myself at its market value, I sell it to myself at a massive discount. And of course, that's going to disadvantage the existing shareholders. So look for related party transactions. Remember, they should be disclosed in the footnotes. We're looking, of course, as well for directors that have strong financial position, a strong financial position. Okay, in other words, they may be able to override the internal controls. Look for as well a situation where the company has power over customers and suppliers because again they could enter contracts at non-arm's length terms, i.e. non-commercial terms. So for example, we could get our customers to buy goods from us at an inflated price now in order to boost our sales in this period, and of course on the flip side we agree that they can buy at a discount in the future. Or alternatively we could get our suppliers to sell goods to us now at a discount, and we could agree in the future we'll buy goods at a premium. So in other words, we're shifting profits between periods by doing that, by essentially putting pressure on our customers and suppliers. Now, of course, we know that the accounts are full of subjectivity. We know the accruals process leads to us making estimates and subjective judgments. So again, we're always worried that these may not be realistic. And of course, some of them are very difficult to corroborate, especially things like impairments, where you're comparing the carrying value of an asset to its fair market value. Well, that's easy, of course, if the asset's exchange traded, but if the asset isn't exchange traded, how do you actually achieve fair market value? How do you estimate the fair market value? Highly unusual transactions that are not covered by existing accounting standards, well, we'd always be worried, of course, that the company has chosen to report them in a way that doesn't show the economic substance. International operations, well, all we're simply saying here is you could actually have a division operating in a country that has weak legal controls over it, allowing you to commit fraud in that country. And then they say from that, operations in tax haven jurisdictions always give us opportunities to commit fraud. Okay, ineffective monitoring of management. So in particular, if you have a director that has complete control over the company, maybe the company was set up by an entrepreneur and that entrepreneur dominates the entire company and as a result has the ability to override the internal controls of the company. Other things to look for are ineffective audit committees or ineffective boards of directors that are not really monitoring the actions of the key employees and directors of the company. Complex or unstable organizational structures, well, what this really means is it's very difficult to find who is responsible for what within the company. And if you don't know who is responsible for what, a fraud could be perpetrated and it'll be very difficult to find out who did it. So what are we looking at here? We're looking at situations where it's difficult to determine the organizational structure, so who is responsible for what. It's difficult to determine who has control over the company, i.e. majority shareholders and the like. We're looking for companies that have over-complex organizational structures, so it's confusing. Again, you can't see who is responsible for what within the company. And the final point, looking for companies with high turnover of key staff members, professional advisors such as auditors and board members. Again, we've got to be asking ourselves, why are these people leaving the company? And of course, if you've got high turnover of key management, you're always bringing in management that don't understand the business, don't understand the existing controls, increasing the opportunity for a fraud. Okay, insufficient internal controls, again within our opportunities, inadequate monitoring of internal controls. So again, this links back to the idea that maybe you've got a weak internal audit department. They look then for high turnover of people in your accounting functions, your internal audit functions, or your IT staff. Again, high turnover means they're going to be unfamiliar with the business and unfamiliar with the internal controls that operate over that business, allowing greater opportunity for fraud. So the final point, again, is ineffective accounting and IT systems. Then finally we said, no one likes to think of themselves as a fraudster, so we're going to be able to, or we're going to want to be able to justify our actions. Now the first point they say is it's easier to justify your fraudulent actions if there's been ineffective communication of the company's ethical values. So the more the company promotes its own ethical values and promotes ethics within the company, the more it's difficult, or the greater the difficulty of justifying your actions if you are going to commit a fraud. Now again, they say look out for non-financial managers involved in the selection of accounting principles and estimates. Again, the question we've got to ask ourselves here is, why are they involved in the selection of accounting principles and estimates? Surely this should be left to people with expertise in this area. Again, look for companies with history of violations and history of improper accounting. Again, the idea is if you've got a track record of violations, it's easier to justify future violations. Look for companies, again, with excessive focus on their stock price or earnings trends. Again, that's going to allow you to justify fraud in order to maintain stock price or maintain your earnings. And again, look for companies, therefore, that overly commit to analyst forecasts, especially if those analyst forecasts are unrealistic or aggressive. Then finally, again, another bad sign is a failure of a company to correct for known errors and breaches in a timely fashion. In other words, as soon as mistakes are found within a company, we'd like that company to be correcting them instantly because it shows that they have a very good ethical code within their company. If they don't correct them in a timely fashion, again, it shows you weak internal controls operating over the business and therefore the ability to rationalize a fraud if you commit one. Okay, again, more attitudes, justifications and rationalizations. Focus on tax reduction may enable us to justify essentially trying to manipulate our earnings down. Attempts to justify inappropriate accounting policy based on materiality. Now remember, in order for the auditors to sign off your accounts as being true and fair, all they're looking for is that you've applied the proper accounting, generally agreed accounting practices to material transactions. So that means essentially if a balance in the accounts was immaterial, i.e. not likely to affect the users of the accounts, you don't really have to apply the proper accounting standards. However, we believe this shows a weakness in the company's attitude. It's best if we apply the proper accounting policy to all transactions with the company, regardless of materiality. Now, another key thing to look for is strained relationships with your auditors. First one, turnover of auditors. If your auditors are suddenly resigning and new auditors are being appointed, you've got to ask yourself, why is this happening to the company? Are auditors resigning or being removed simply because they refuse to sign off on the accounts being true and fair? So look for disputes, disagreements with the auditors. Look for unreasonable demands on the auditors. In particular, time pressure, where the company is demanding that the audit is completed within a very small period of time. Well, again, the auditors should have sufficient time to form a rational opinion on whether the accounts are true and fair. Again, if the firm attempts to limit informational access or the auditor's scope to obtain information, again, well, hopefully the auditors would be actually saying we can't form an audit opinion, but again, it's a weakness in the company. Okay, now the SEC essentially has 4 categories based on their enforcement actions. So these enforcement actions are where the SEC have required companies, listed companies, to restate their accounts. And the LOS here says describe common warning signs and methods of detection. Now between 1997 and 2002, 515 different enforcement actions were issued by the SEC. So let's have a look at where some of those were. Some of the biggest number of enforcement actions, in fact 126 out of those, over those total of, how many did I say there were? 515, didn't I? 126 of them are due to improper revenue recognition, i.e. incorrectly stating sales. So recording sales that just didn't exist, using percentage of completion when you should have used completed contract, bill and hold strategies, etc. Second one, improper expense recognition, about 101 enforcement actions for that. So in other words, maybe capitalizing expenses that should have, or capitalizing costs that should have been expenses, should have been expensed, I should say. Improper accounting for business combinations. We know the issue here is our fair market value adjustments when we acquire a subsidiary. There were 23 enforcement actions there. And then finally, anything else really, other accounting and reporting issues. This totaled 130, and it includes items such as improperly recording related party transactions between the company and directors, etc. Okay, so that gives you an idea of where some of these enforcement actions were occurring. So our next LOS says describe the common warning signs. So this is what we should be looking at or looking for when we look at a firm's accounts. Bill and hold. So we're looking at aggressive revenue recognition first of all. Bill and hold just means invoicing a client, invoicing your customer for a sale even though you haven't shipped the goods. So in other words, if you invoice the customer, and you could potentially record the sale and record the accounts receivable even though the goods have yet to be shipped. Now we know that essentially that's recording a sale before the earnings activities have been complete. Now if you're a leaseor, i.e. a company that owns assets and leases them out, there are 2 major types of leaseor accounting, and that's sales type leases and direct financing lease. If you account for a lease as a sales type lease, it allows you to recognize more of the profit on the lease up front. So again, we'll be worried about companies that should be using direct financing lease methodology, using sales type lease methodology, and as a result accelerating revenue recognition. Recording revenue before earnings activities are complete. Again, remember, in order to record a sale, the 2 major criteria are earnings activity should be complete and we should have reasonable assurance of receipt from our customer. So in other words, and the first one is really that bill and hold again, recording a sale before the delivery of goods, and the other one, of course, recording a sale before you've completed the earnings activity, i.e. before you've met all contract terms. And the final one is using swaps and barter agreements to generate sales. Now our second point is the divergence of CFO and earnings. Now generally we like our earnings to be backed by cash. So the closer net income is to cash flow from operations, the stronger we feel their earnings quality is. In particular, the real worrying sign is if you spot earnings that are positive but cash flow from operations that is negative. In fact, what we would really like to be looking at is cash flow from operations divided by net income, and essentially if it's less than 1 or it's showing a declining trend, it's indicating that our earnings aren't being generated by cash items. Instead, we're manipulating the accruals process to generate earnings. And the significance of using the accruals process to generate earnings is accruals automatically reverse. So any earnings you generate by using the accruals process now will come at the expense of lower earnings in the future. Now again, growth of earnings or growth of sales out of line with your competitors. Again, that would lead us to question the quality of earnings. Evidence suggests it's very difficult to exceed median earnings in the long run. So in other words, if you looked at the company and it had revenue that was growing faster than competitors, but you couldn't spot how it had a competitive advantage, you might want to question the quality of those earnings. Now, a good thing to look for is accounts receivable growing faster than sales. It could therefore indicate that they're recording non-existent sales. As long as you maintain your double entry, i.e. you go credit sale, debit accounts receivable, the accounts are still going to balance even if the sale never took place. So if you notice accounts receivable growing faster than revenues, it could be the indication of non-existent sales being recorded. Growth of inventory out of line with peers or stock holdings days increasing. Now, of course, this could indicate inventory management problems, i.e. you're stockpiling. Or the big one, it could indicate obsolete inventory where the company has not written it down. Remember, we're meant to record inventory at the lower of cost and net realizable value. So if inventory levels are increasing out of line with your competitors, it could indicate that there are write-downs that haven't been recorded in the accounts. Now again as well, we've got a motivation sometimes to overstate ending inventory, because if we overstate ending inventory, we reduce our cost of goods sold. And if we reduce our cost of goods sold, we maximize our earnings. And if we maximize our earnings, of course, it could therefore affect our share price. So in other words, you might see a company with a motivation to overstate its ending inventory. Classification of non-recurring or non-operating items as revenue. Well, again, maybe we've got a load of investment returns, interest, dividends, realized gains and losses, and rather than treating them as non-operating items, non-operating income, we put them through our sales line in our accounts to mask a decline in our revenues. Deferral of expenses. Now, the classic example of deferral of expenses, of course, is WorldCom, where they took a few billion of their day-to-day operating expenses and incorrectly capitalized them. Now, of course, this means the expenses are not going to be in the income statement, giving you higher earnings in this period. Well, okay, you've got higher earnings in this period, but do remember that it's going to come at the expense of lower earnings in the future. Because if you capitalize these expenses, you're going to find you get higher depreciation in future periods. The seventh warning sign is excessive use of operating leases. We know we're not a big fan of operating leases because, of course, it keeps the asset out of the balance sheet, it keeps the liability out of the balance sheet. And this, of course, is why most analysts will capitalize operating leases by calculating the present value of minimum lease payments using footnote disclosure and installing an asset within plant, property and equipment and creating a liability before calculating ratios. Classifications of losses and expenses as extraordinary or non-recurring. Well, of course, this is the idea that maybe we have a load of day-to-day expenditure and we try and hide it in discontinued operations. Why might we want to do that? On the hope that the analyst doesn't build these expenses into their future earnings forecasts. So again, look for non-recurring items. Look at how frequent they are, and also look for maybe big spikes in discontinued operations at the same time as you get improvements in maybe gross profit margin or operating profit margin. LIFO liquidations. Well, what is a LIFO liquidation? It's where a company, of course, uses LIFO. And remember, if you use LIFO, you're storing all of those old purchase prices in your ending inventory. So you use LIFO, you build up your ending inventory for a number of years, and then suddenly you reduce your stock levels. That releases all of those old, out-of-date prices back through your cost of goods sold, giving you a lower cost of goods sold and boosting, therefore, your gross profit margin. So in other words, look for a company that's using LIFO and then suddenly reduces its inventory levels. So how would we pick up on this? Well, maybe declines in the LIFO reserve. Okay, so why might LIFO reserve decline? It could be as a result of LIFO liquidations. It could, of course, be as a result of falling prices as well. Now, we're not so worried about falling prices. Gross operating margins out of line with gross or operating profit margins out of line with your peers. Well, gross profit margin, well, of course, that's gross profit, sales minus cost of goods sold over sales. Operating profit margin, typically EBIT over sales. Now, again, if they're out of line with peers, it could indicate aggressive accounting policies. It could indicate we've overstated our inventory. As a result, we've understated cost of goods sold. Or it could indicate, as we mentioned earlier, we're missing a load of operating expenses in our income statement. Why? Well, maybe they've been incorrectly capitalized and stored in the balance sheet. Always, of course, worth reviewing economic lives of your plant, property and equipment and your intangibles because, of course, the longer the economic life, the smaller the depreciation expense or amortization expense that goes through the income statement. So in particular, the analyst has to review the footnotes here to spot the economic life and ask themselves, does that look reasonable? And of course, also what you're trying to look at here is changes in the useful economic life. Remember, if you change the useful economic life, it's deemed to be a change in accounting estimate. You do not need to go back and restate prior years. You just disclose in the footnotes and apply that new economic life going forward. Pension assumptions. Well, of course, our pension income statement pension expense is reliant on a number of different assumptions from our actuaries, such as the discount rate used to calculate service cost and interest cost. Essentially, a higher discount rate is going to give us lower service costs and as a result, a lower pension expense. Higher expected return on plan assets, again, gives us a lower pension expense. And lower rates of salary increase of our employees is going to give us a lower service and as a result, pension expense. So just be aware, pension assumptions can be used to manipulate the pension expense and as a result, earnings in the accounts. Look as well for fourth quarter earnings surprises. So either unusually high revenues or unusually low expenses. Now, of course, for some firms, you might get high revenues in the fourth quarter because of seasonality. So, for example, if you were to sell goods linked to Christmas, you'd expect to see boosts in sales coming in the last quarter of the year. But if we can see high revenues and low expenses where we cannot justify it by seasonality, again, it can be a good indication that we've manipulated our earnings. Enron, for example, had fourth quarter earnings surprises where we couldn't link it to seasonality. Point 14, equity accounted or unconsolidated special purpose entities. Now, of course, we don't like equity accounting because what we do with equity accounting is we bring in our share of the assets minus the liabilities of the special purpose entity. In other words, we bring in our share of its net assets. And because it's very thinly capitalized, net assets are very small, i.e. assets are only marginally higher than liabilities. Now, you shouldn't really be seeing this going forward. US GAAP has now changed. Post-Enron, it removed the idea of equity accounting or special purpose vehicles. It said now if you had risk and reward, your special purpose vehicle is a VIE, a variable interest entity, and it must be consolidated. But it still had this idea of qualifying special purpose entities that could be used for financial transactions and they could still be equity accounted. Well, recently that's been removed as well. So point 14 shouldn't be such a big issue going forward. Off-balance sheet financing, well, we've talked about operating leases being our classic, but look for other ones such as throughput agreements, such as take or pay contracts as well.